Have you ever opened your investment app during a lunch break and suddenly felt a slight tightness in your chest as the numbers that usually bring hope turn red? Within minutes, your thoughts start moving faster than the market itself. Not because the money disappeared that day, but because fear begins writing its own story. Strangely, many investors lose their biggest amounts not during the market drop itself, but while trying to escape the fear that follows it. When prices fall sharply, the brain usually notices danger before it notices opportunity, even when that danger may not actually be real. In moments like these, a strategy built over months can unravel within minutes, often because of emotions that remain unnoticed. That is why some people emerge from a crisis stronger while others carry regret for years, and the difference is often found in the reaction itself. At the margin, we do not treat investing as a game of predicting the future. We examine how money and emotions quietly shape modern decisions. Today, we will look at 3 investing mistakes that often turn temporary losses into permanent ones, and the last mistake may be more common than most people realize. Most investors think the problem begins when the market drops, but the larger problem often starts a few minutes later. A market decline triggers a deeply human sense of fear, and that fear immediately starts searching for reasons to justify itself. We begin consuming more news than usual, yet what we often seek is not information but confirmation of our anxiety. At that point, strategy slowly gives way to emotion, and emotion almost always focuses on short-term pain. This is the panic cycle. The market falls, fear rises, and emotion replaces strategy. Once strategy disappears, poor decisions begin appearing one after another, and they rarely arrive alone. Investors sell too early, stop investing, or buy something without a clear plan, and each choice feels logical in the moment. The problem often becomes visible only months or years later when the market recovers and previously sold positions begin rising again. Ironically, many permanent losses begin with fear of temporary losses, which is where psychology becomes more important than prediction. During market panic, the greatest challenge is not understanding charts, but understanding yourself. The first mistake is panic selling, and it may be the most expensive investing mistake people repeatedly make. When a portfolio falls 20 or 30%, selling can feel safer even when safety and correctness are not the same thing. Many people sell not because they expect gains elsewhere, but because they want the discomfort to stop. The problem is that markets do not ask for permission before recovering, and rebounds often arrive while fear is still everywhere. When investors sell in panic, a loss that existed only on a screen becomes a permanent loss in real life. What is interesting is that many investors sell not because of analysis, but because uncertainty becomes too difficult to tolerate. Modern life trains people to avoid risk quickly, yet investing often rewards those who can tolerate volatility for longer periods. This does not mean every asset should be held forever, but major decisions should come from strategy rather than panic. Markets move through cycles, yet fear often convinces people that this downturn is somehow the end of everything. Nearly every generation of investors has believed the same thing before, which is why this small tragedy keeps repeating itself. The second mistake sounds more reasonable because many people stop investing when prices are falling. The logic feels simple. Why keep putting money into a market that appears to be falling apart? Yet markets rarely offer discounts when everyone feels comfortable, and lower prices often appear when fear is widespread. During the 2008 financial crisis, many investors stopped making contributions and waited for conditions to feel safer. Unfortunately, by the time that sense of safety returned, prices had already moved much higher. This is not about extreme bravery. It is about recognizing how market cycles operate over time. Lower prices often mean more investment units can be purchased, although fear can make that simple fact difficult to notice. The human brain tends to buy when optimism is everywhere, even though better value often appears after optimism fades. Many investors treat a market decline as a signal to stop, while more disciplined investors view it as a phase to move through. The difference may seem small today, but its effect can remain visible across many decades. The third mistake moves in the opposite direction, not selling too quickly but buying without a plan. When markets fall, the internet fills with confident claims that every asset is suddenly a bargain. The problem is that a lower price and real value are not automatically the same thing. In 2022, many investors bought collapsing assets simply because the discount appeared too large to ignore. They were afraid of missing an opportunity even though they did not fully understand what they were buying. When fear meets greed, the decision becomes blurry and the emotion simply changes its costume. Calm investors usually have criteria before buying, while panicked investors often create criteria afterward. The difference sounds small, but it becomes much larger when prices keep moving lower. A clear strategy may not deliver fast gains, but it can reduce costly mistakes over time. In investing, avoiding major mistakes is often more important than finding major wins. The three mistakes share the same root cause, and it is not a lack of information but a natural human response to uncertainty. Our brains evolved to keep us alive, but modern markets do not always reward the same instincts. When we see losses, the emotional pain often feels stronger than the potential benefit of future gains, a bias known as loss aversion. Even professional investors experience this effect, but many rely on systems that prevent emotions from taking full control. Warren Buffett once described the market as a mechanism that transfers money from the impatient to the patient. In investing, patience is often less about waiting and more about resisting the urge to overreact. In an age of constant notifications, we are repeatedly encouraged to take action at every moment. Sometimes the hardest choice is doing nothing at all, even when buying or selling feels easier. Markets often test emotional control more than they test the ability to read volatility or price movements. It is a challenge that receives little attention, yet nearly every investor encounters it at some point. If the panic cycle begins with fear, the answer is not extreme confidence but a clear structure that remains in place during uncertainty. Disciplined investors usually decide their rules before a market decline instead of waiting for emotions to provide direction. A simple rule often works better than a complicated prediction because the rule still functions when thinking becomes messy. Defining an investment goal early helps separate market noise from what actually matters to your real needs. A consistent investing schedule reduces the need to make the same decision again whenever the market moves. Limiting the news that triggers panic can reduce unnecessary reactions that do not improve decision-making. Volatility is not a system failure, but a normal part of how markets operate over time. A market that rises all the time may feel comfortable, but that version of the market rarely exists. Accepting uncertainty is part of investing, and that acceptance often occupies a different role than prediction. When expectations become more realistic, fear often loses part of the influence it previously held over decisions. Many people assume investing is mostly about finding the best asset, when much of the challenge actually comes from managing their own behavior. A portfolio can recover from a difficult market period, but repeated emotional decisions often leave a much deeper impact. Market declines are uncomfortable experiences, and pretending that fear does not exist does not change that reality. Fear may still be present during volatility, but it does not automatically have to direct every decision being made. Successful investors are not always calm people. They simply continue operating when calmness becomes harder to find. That structure keeps people moving along the same path, even when headlines appear to point somewhere else. Every market crisis looks different on the surface, yet the underlying psychological pattern often repeats itself. Fear appears first, rushed decisions follow shortly after, and regret tends to arrive later in the sequence. Recognizing that pattern creates an advantage that comes from behavior rather than from access to information. Over a long-term time horizon, behavioral advantages often become one of the biggest differences between outcomes. A market decline does not always destroy wealth, but decisions made while fear takes control often do far more damage. Successful investors are not the ones who are always right, but the ones who remain rational when discomfort appears. The direction of the market next week may be outside our control, but our response to it still is not. Small moments of control can create surprisingly large differences over a long time horizon, even when nobody notices. If this video changed the way you look at the market, then it may have offered a different perspective rather than another prediction. In the end, investing is not only about money but also about how people deal with uncertainty over time. For more discussions about money psychology, modern financial realities, and the decisions that quietly shape the future, follow the margin. Which mistake do you think hurts investors the most during a market drawdown? Panic selling, stopping investments, or buying without a clear plan?